Okay. So now we're going to talk about the modifications. Okay. Modifications accounting, right? Modification accounting, right? Modification. Okay. What is the meaning of modification? The meaning of modification here, we are trying to say, let's say you have entered into an arrangement between the employer and the employee, or between the employer and the non-employee. Now, as you picked up, these options were to vest over a 3-year period or a 4-year period or a 5-year period, and there were service conditions, there were performance conditions, and this and that. And you realize as you go along the way, look, my share price has depressed significantly, right? So this is no longer an incentive from an employee retention strategy perspective. And hence what you do is that, and when you look at a stock option arrangement, okay, there are number of variables which are there in a stock option arrangement, number of things which are out there in a stock option arrangement, okay. And they are your in a way, when you look at a stock option arrangement, right, between the employer and the employee, you need to be clear on the exercise price, right? At what price the option will vest, okay. Then you know the term of the option, right? Term of the option, the vesting conditions, right? The vesting conditions and the quantity. So essentially, between the employer and the employee, you need to know how much I'm going to receive, how many number of shares, what are my vesting conditions, which is a service condition or a performance condition or a market, and performance condition is a market condition or a non-market condition. What is the term, right, over which this service condition is a 2-year, 3-year, 4-year, 5-year? What is the term of this option, right? And this performance condition, over what period I need to meet those performance conditions, right? And what is the exercise price? At what price I can exercise the shares, okay? Or at what price point reference you will compute the delta, right, of what benefit. If it is a cash settled, so today the price is 100, what was my baseline, right? That today the price is 2 rupees versus 100 is what you are entitled for the benefit. So these are the 4 things possibly you will see in terms of the common understanding between the employer and the employee, right? Now, if you realize that, that the share price itself has depressed and it is no longer serving any meaning, this paper is, the arrangement is just, is not even worth its weights, as we call it, then I need to revise, I need to modify the terms and conditions, okay? So if you were to modify the terms of the arrangement, then what it says that you need to determine your original compensation cost anyway, okay, because that was known on the date of the grant, that plus the increase in fair value on the date of the modification is what you need to record. How will you do that? You will determine the fair value of the option, as we call it, okay, fair value before modification and after modification. Okay, you need to determine the fair value before modification and immediately after modification, okay, and then you determine the change in value. That means what is the incremental benefit I'm giving to the employee as a result of this modification. So the original compensation cost plus the cost which is to be determined because of the modification, the incremental compensation cost, the entire cost then has to be recognized as the compensation cost over the period of the service. All right, we will try and understand this with the help of an example, right? So what we're saying, the services received measure the grant dated fair value of the equity instrument granted unless those do not vest because failure to satisfy a service condition or a non-market performance condition, right? Applies irrespective of the modification. The entity shall recognize the effect of the modification that increases the total fair value of the share-based payment arrangement, otherwise beneficial to the employee. And how you determine this fair value? Immediately before and after, okay? Let's just try and understand this with the help of an example. Foster Limited has granted 150 share options to all its employees, okay, 1,000 employees. The grant requires the employees to remain in service for a period of 3 years for the options to vest. That 3 year service condition. The fair value of the option on the grant date is INR 120. Okay. Now the date below provide information, the data below provide, right? The data below provide information about the actual and estimated number of employees and other plan details related to the plan. Okay. 35 employees have resigned out of 1,000. Company expects that 60 more will leave in the next 2 years. The plan will vest for 905. The share price of the company has fallen, and accordingly, the fair value of the option is reduced to INR 50. Foster Limited carry out a repricing, and now the fair value of the option is INR 80. Okay. So we did a repricing, and now the fair value of the option after the repricing, that means there's increase of INR 30. Okay. The original date fair value, right? What was the original date grant date fair value was 120. Okay. Now 40 employees have again resigned. Company expect that 25 more employees will leave in year 3. All right. And 22 employees have resigned. Okay. Right. 22 employees have resigned. And finally, the plan vests for 903 employees. Okay. Awesome. Now, what should be the accounting treatment for modification to be provided by Foster Limited for the 3 years? So I'm going to do accounting for year 1, 2, and 3, right? And it eventually vests to 903. When I granted, the granted fair value of the option was 120. There was a significant reduction in the stock price, as a result of which I did the repricing, right? On the date of the repricing, the fair value of the original option was how much? 50. After the repricing, the fair value gone up to 80. Okay. That means the 30 is the incremental benefit to the employee. So how much as an employee you get? You get 120 plus 30. So you have received the total benefit of 150, right? You have received the total benefit of 150. That is my compensation cost. Okay. Now let's look at how do we record this. Foster Limited has carried out a repricing, and hence the company should follow the modification accounting, right? Repricing is carried out at the end of year 1. The increase in expense will be recognized over the next 2 years only. Okay. So number of employees 1,000, expected to vest 35, right? 60, and then 905, and option granted per employee was 150. Okay. And similarly in year 2, 900 and 903, right? And then that's the employee status. Okay. That's the employee status. Now we are going to look at how do I record the cost. Okay. How do I record the cost? Okay. How much is the cost in each of the years? Okay. So in year 1, it is nothing but 905 multiplied by 150 and multiplied by 120. So it is 905 into 150 into 120 divided by 3. That's the cost in year 1. Now in year 2, I did the modification at the end of the year 1. That means assuming it is actually effective year 2. So I'm going to do accounting here 900 into 150 into 150, into 2 by 3. That's what will happen, right? In year 2 and year 3, the balance cost will get recorded. So year 2, there will be significant increase in the compensation cost compared to year 1. So if you see in year 1, my expense is 54,30,000, which is 905 into 150 into 120 into 1 by 3. Now in year 2, I'm not only recording this 53,70,000 plus I need to record the 20,25,000, the modification cost as well. Okay, I want to record the modification cost as well, 1 by 2. This cost also I need to record. And similarly, this cost, the balance is 20,38,500 is what I will end up. So modification of 30 rupees will get recorded over year 2 and year 3 in a way from that perspective. Okay, I hope this is clear to you, right? Fair value of the option 120, 120. Then there's a modification benefit 30, 30, and then that's how you will end up recording the. So I think the way this thing is being done is that the modification benefit is being recorded over the 2 year period. Okay, modification benefit is recorded over the 2 year period. So if I were to just kind of look at, yes, here I think this possibly needs some action, right? So here what we are doing is maths. You know, we've got to be very careful. So 900 into 150 into 120, that is 2 by 3, and then the 30 is 1 by 2 in a way. That's how the I think the attribution is needs to be considered. Okay, you got to be careful. Many times these are not very intuitive. Okay, now if there is a cancellation or settlement of stock option arrangement, what does that mean? So let's say I had given so many options, now options are just not in the money, so I just want to cancel the plan, right? Now cancellation results into recognition of all unrecognized compensation cost immediately. Whatever was left to be recorded, that needs, it doesn't mean, cancellation doesn't allow you to reverse the unrecognized compensation cost. Okay, that's the important principle, is you should remember, cancellation, you got to immediately record the unrecognized compensation cost. And similarly, you got to understand the terms of the settlement to assess. A settlement is also like a modification, as we understood, right? Cancellation is like a modification. So cancellation, any unrecognized compensation cost to be recorded immediately. Settlement, you got to assess that how this, all of this in a way looked at. So whatever was the original compensation cost plus the incremental compensation cost, if any, on the date of settlement, that you need to record as a result of the settlement. So if a grant of equity instrument is cancelled or settled during the vesting period, entity shall recognize immediately the amount that otherwise would have been recognized for services received and the remainder over the remainder. So immediately you have to recognize, which otherwise you would have recorded over the remaining service period. Any payment made to the employee on the cancellation or settlement shall be accounted for as a deduction from the equity, except to the extent that the payment exceeds. If the payment exceeds the fair value, again, this is like a settlement. So immediately on the date of the settlement, right, what was the fair value of the option? How much money you have paid? If the fair value of the option on the date of settlement was at 10, but you paid 20, right? So the additional 10 is an incremental compensation cost. Okay, the 10 what you paid was in settlement of the original award which the employee was entitled for. But if you paid 20, that means you paid over and above the fair value of the option, then that extra 10 is an immediate charge to the profit and loss. If new equity instruments are granted to employees, an entity identify the new equity instrument as replacement equity instrument, again for the cancelled equity instrument, the entity shall account for the same way as a modification, as we just explained. So let's look at this with the help of an example. Popular Limited has announced a share option scheme for each of its 12 directors. As per the scheme, the company has granted 1,000 share options, okay, to each director and is required to be in service with the organization for 3 years from grant date. Okay, so 1,000 share options to each director and required to be in service with the organization for 3 years from the grant date. The exercise price of the option is INR 100. Estimated fair value of the option is INR 120. Expected number of directors to vest out of 12, 10. In the second year, the company performance and the market share in the industry has deteriorated hugely, and hence the management agreed on cancellation of the share option scheme immediately. Cancel. Okay. Now, what does it mean? Right. Now, if you've cancelled it, right, and then you got to record the compensation cost, right, and then let's say there are more details. Fair value of the option at the time of cancellation was INR 8. Market price of the share at the cancellation date is INR 15. Okay. Considering the cancellation of the share option scheme during the vesting period, the management decided to pay a compensation of INR 85 per option to each of the directors. At the time of cancellation, there were 11 directors who were currently employed with Popular Limited. Okay, there were 11 directors who were currently employed with Popular Limited. So what do you do? What should be the accounting treatment to be followed by Popular Limited for the cancelled scheme and related compensation? So if I have 11 directors, my original fair value was 120 of the option, right? Over a 3-year period, I need to record that cost immediately, whatever was the remaining cost. And then I paid them 85 rupees and the fair value of the option was 8 rupees. So 85 minus 8 is how much? How much? Is 77, is also required to be recorded as an incremental compensation cost over and above the 120, which anyway I need to record. Let's go through the solution. Calculation of the compensation, expected number of directors to vest, 10, 120 was the fair value, 1000, so total was 12 lakh, expense weightage for the year, 1/3, then 4 lakh is what I have recorded as a cost. Now I come to year 2, right? Now year 2 actually was 11, 120, the 1320 full as it is cancelled. So 13,20,000 minus 4 lakh, 9,20,000 is the remaining cost is I need to record immediately. Okay, that's the principle. If it cancelled, it is assumed that all of this is vested. Okay, and you got to record the cost immediately. Now you paid the over and above, right? Number of options. So you paid the 11 into 85 into 1000, 9,35,000, right? Compensation, extra compensation, cash, which I paid. What was the fair value of the option, right? To be deducted from equity, 11, fair value was 8, number of options for each director, 1000, 11 into 80 into 1000, right? 88,000, 11 into 88, sorry, 11 into 8 into 1000, not 80. 11 into 8 into 1000, which is 88,000, right? And how much we paid? 935. So 935 minus 88, okay, which is amount will be 8,47,000, which is nothing again but 77, right? So if you look at 77 into 11, right, into, okay, you will get to 8,47,000, right? Yeah, I hope so. Let me do a quick math here. So if I do this, 77 into 11 into 1000, yeah, 8,47,000, right? You get the same number. Awesome. Okay. Share price of 89 has no relevance, or whatever the share price, it has no relevance to accounting for cancellation of shares, right? What was the share price? Share price was 15, right? Let's go back. Yeah, share price was 15, right? Share price of 15 has no relevance. Okay, is 15 has no relevance. 15 has no relevance in accounting for cancellation of shares. Okay, now let's talk about how do you calculate the fair value of the options. Okay, that's important. It's an important because that's how you determine the total compensation cost. All the share-based payment plans are recognized referring the fair value at grant date. And if it is for non-employees, then it is the value on the date when the goods or services are received. And when it is related to a cash settle, then anyway at every measurement date you true up, right, for the amount of the liability to be paid out. Now all the share-based payment plans are recognized referring fair value at grant date, and it is crucial to understand how the fair value is arrived and the specific guidance available in the standard. So considering both the market related condition and non-vesting conditions, right? Valuation techniques are used by the entities. You have to use a valuation technique, which is an option pricing model or a binomial model or a lattice model. There are a number of statistical models which are out there, which are used to fair value when you look at in those options which are traded in the market, right? So but they are very short term options like 1 month, 2 months, 3 months. So that's how you, there's a fair value of the options which are traded. But here these options are actually long term, 3 year, 4 year, 5 year. So you don't have the market which is available where you can determine the fair value, and that is why you use a valuation technique, and that is what is called level 3 valuation technique under Ind AS 113. This is the level 3 evidence, right? But we have no choice because these are not traded. Okay, these are not traded. Okay, so a Black-Scholes option pricing model or a binomial model are being used widely and are generally accepted, right, from that perspective. perspective. So if you want to learn more about this, you will again you can find these models. They're available again on Google and all of that. So what are the minimum inputs which needs to go into, right? Exercise price of the option. At what price I as an employee needs to pay to exercise. What is the life of the option? What is the current price? Now life here is not the contractual life. Contractual life is just 10 years, right? Here is the estimated life, because look, the employee can exercise between 4 year to 10 year, right? So it is anywhere between 4 to 10 year. Could be 4 year, could be 5 year, could be 6 year, could be 10 years, right? Depending upon your estimate that what is the life over which this employee is likely to exercise once vested. So it can't be lower than vested, but it can be anyway anything between 4 to 10 years, right? It's again a subject matter of estimate, right? The current price of the underlying shares, right? What's the price of the underlying shares? Current on the date of the grant, what's the market price? What's the expected volatility? That's an input. The volatility is an input in option pricing model, and you compute again volatility using a statistical formula. The dividend expected on the shares and the risk-free interest rate, all these are your input in an option pricing model, and then that determines the value of the option. The value of the option multiplied by the total options into the number of employees is your total compensation cost, and then you also factor in the amount of forfeitures, right? And then that becomes the cost which is to be recognized. And then if the conditions is a service condition, if the employee has fulfilled, that cost is recorded, end of story. If the employee has not fulfilled service condition and hence the options are forfeited, if that been the case, then you reverse the cost which has been recognized, right? Or you keep on truing up for your change in estimates. If it is a performance condition, which is a market condition, as we said, you are not allowed to reverse the cost if the service condition is met, okay? Because for market-based performance condition, you actually also do an input in determining for market-based, okay, performance condition, that is an input in determination of the fair value of the option, and hence if the service condition is met, this compensation cost is not allowed to be reversed. However, if it is a non-market based performance condition, okay, and you have determined the total compensation cost, okay, then and if that non-market based performance condition is not met or is not likely to be met, then you are not required to record the compensation cost, or if you've recorded anything previously, you are allowed to reverse it, or you are required to reverse it. And but if it met subsequently, then you again have to record it. So you got to be very, very careful, clear in terms of all these nuances as we look at accounting for share-based payments, right? So total expected charge, you will determine at the grant date, okay, linked to the total number of options, grant date fair value options, and the percentage which is expected to vest, right? Accounting for condition, grant date fair value options, non-vesting conditions, do not true up during vesting period or on vesting date, expected to vest, service condition, non-market performance condition, all of that is we talked about. Here you need to true up estimate during vesting period and on vesting date. So if it is a cash settled share-based payment, then that required to be remeasured, okay? If it is equity settled, then you determine the value on the grant date. But if it is cash settled, then you need to keep on truing up till the time the liability is settled, which is normally coincide with the vesting date. Now, in a share settled stock option arrangement, the vesting period, vesting date, and the contractual life of the option employee may exercise at any time over that period. All right. Okay. I hope this is clear to you, and this is all making sense, and you've been able to fully appreciate of what we're trying to